Good afternoon and welcome to the BEEKS Financial Cloud Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you up to Gordon MacArthur, CEO. Good afternoon, sir.
Thanks, Alessandro. Good afternoon. Good afternoon, folks. Gordon MacArthur, CEO and founder of BEEKS Financial Cloud.
Good afternoon, everyone. Fraser McDonald, CFO of BEEKS Financial Cloud.
So, as usual, I'm going to kind of start, go through the opening few slides. I'll hand over to Fraser for the financials, and then we'll get some Q&A at the end. So, we'll start just by doing a kind of brief introduction and overview of the company. So, BEEKS Financial Cloud, we are a cloud computing company for financial markets, mainly focused on capital markets within the financial market segment, but not solely and exclusively. We are, probably the largest pure play cloud provider in capital markets. We do three areas of our business is broken into three areas: compute, connectivity, and analytics. We have various product offerings within that. Product offering has evolved over the last few years. The business started providing public cloud environments only, where clients would come in over the internet and buy compute resources in various financial services data centers around the world. After IPO, we built out a private cloud practice where instead of a fully shared environment, larger clients would buy dedicated resources from us, and we would size an infrastructure that has some dedicated resources for them and some shared networking. And then over the last 2 years, the business has invested heavily in our proximity cloud and exchange cloud offerings that I'll cover in a little bit more detail as we go through the slides. So the scope of the business now caters from individual traders, retail traders, all the way up to tier one stock markets, banks, investment managers, the largest hedge funds in the world. So we've got a real distribution in terms of the areas of the markets that we cover. And our business is building the cloud to support low latency multicast trading environments, right? Where we don't host CRM systems, email platforms. It's all trading banking infrastructures that run on our platforms. Next slide. So just to kind of cover the previous year. So I think our revenue was up 22% to 22.4 million. Our committed monthly run rate was up 23% to 23.8 million. That's really how we look at the overall health of the business. That ACMRR figure is what clients have committed to spend with us on a month-to-month basis. Some of that is still going through deployment, majority of which is already deployed and billing. EBITDA was up 33% to 8.4 million. So I think overall, the growth in the business is really from the private cloud wins that we had throughout the year. We flagged in Q1 that we were close to signing a couple of larger exchange cloud deals. Frustratingly, they kind of slipped out the period. Subsequently, though, I think we announced in July that we had signed Johannesburg Stock Exchange. That was one of the deals that we've been working on. So all revenue slipped out in the period for that. But that's now been deployed as billing. I was over in South Africa the last few weeks ago to do the launch of the exchange, and the level of interest and demand is much higher than we had hoped or expected. And we're in the process of filling up that phase one deployment and working with Exchange on what does phase two look like to satisfy the demand. We'd always said previously that Exchange Cloud was worth between 5 and 20 million over a 4-year period depending on the size of the exchange. We thought Johannesburg would have been at that lower end, but hopefully we can see more revenue than we originally expected when we signed them, just due to the uptake that's happened so far with customers already kind of committing to fill up that phase 1 environment, as I said. So frustrating that it slipped out the period, but it's been delivered, it's been signed, it's been delivered, and the uptake is much stronger than we'd hoped. So, if we strip out the slippage on the signing, it's been a good project for us. The private cloud that we has built the business over the last 3 or 4 years continued to perform strongly over the period, and most of the growth came from the smaller private cloud wins. I think we also announced some just after year end, about $4 million worth of new signings in the summer, so that will help the numbers for the next year. We continue to invest in product innovation. Exchange Cloud and Proximity Cloud are being built with further feature function as we get further down the line with some of the exchanges and some of the Proximity Cloud single-use clients. I think one of the other positives for the period is, for the first time since IPO, I think, Fraser will correct me if I'm wrong, that we were cash flow positive for the period, and he'll cover that a little bit more. So I think looking into the coming year, just the bottom point on slide 4, we were sitting on just over 25 million of AC MRR, and with the NRCs that we've picked up through GSE, because Exchange Cloud, we recognise a chunk of the revenue in advance or after it's been deployed. I think we'll be sitting on about 26 to 27 million of delivered revenue after Q1, which kind of gives us 90% coverage for the forecasts, I think, that are out there for the coming year. So we're in a good position to execute strongly in the year ahead. So I covered a little bit about GSE. So GSE are now live. ICE, we previously talked about in presentations, it continues to grow. And we have another large exchange that we are still in material discussions with to try and get them over the line, as we flagged in Q1. It's just taking longer than we hoped. It's not disappeared by any stretch of the imagination. If anything, we think it's a larger opportunity than previously, but due to that, it's just taken longer to go through the due diligence of the process on their side. So we'd hope to get that exchange over the line over the next coming period. And then there's other exchange conversations in the pipeline. So it's not by any stretch of the imagination. It's just the ones that we've flagged. So on the GSE, I think our strapline now is Exchange Cloud enables an exchange to become the cloud. There's been a lot of large announcements with the hyperscalers where exchanges are moving to the cloud. I think there's still no technical solution to how you do high scale matching in a cloud environment. So we always said when we see these announcements, we still believe that BEEKS has a material part to play in. And what will happen with these exchanges is they'll have a hybrid cloud model where there'll still be some co-location and customers connected directly to that. And then back and middle office functions can move up into the cloud where latency and things like that really aren't important. So our pitch to exchanges, it's a moneymaker for them. They make money rather than handing the profit and the revenue over to the hyperscalers. The exchanges own their own data centers. We enable them to offer the cloud within that data center that they then white label to their clients. So it's a revenue and a profit opportunity for the exchanges, and quite a significant one. And then there's a lot of other benefits that sit around the sides. So I'll use this as the Africa example again. It's a difficult country for some of the larger Western institutions to do business in. There's rolling power outages, there's infrastructure issues. So giving clients the ability to spin up real-time infrastructure in the exchange that's directly connected to the matching engine, it makes the barriers to entry to trade in that exchange a lot lower. So it will improve liquidity, it will improve the amount of market participants. So all of the benefits that increase the exchange's core revenue profile from matching trades, we enable and we make life easier. And the also added benefit is becoming the cloud themselves gives them a profit and a revenue generation potential, and it's significant. It's not just a small opportunity for them. It's significant in terms of revenue. So to go to the next slide. So we covered kind of Exchange. So Proximity and Exchange Cloud are really in the same product family. Proximity Cloud came first, where we built these standalone cloud platforms that we deliver to client spaces or our spaces or on-premise data centers. Proximity Cloud is really a single-use platform. It's for the bank or hedge fund or investment manager to use solely for their own purposes. It's the exact same underlying technology for Exchange Cloud. Exchange Cloud just is a multi-homed environment. That means you can have multiple end users taking their own slices of infrastructure securely within the same platform. So Proximity and Exchange, really the same family of products. And then Private Cloud is I wouldn't say legacy business. It's very still much forefront of our minds. It's the kind of core driver that we've had for the last 4 or 5 years, and it continues to perform well. We expect the same for this year. The forecast in the market, we can more than able to get there with just Private Cloud and the small Proximity Cloud deals alone. Move on to the next slide. So I think we continue to innovate in Proximity and Exchange Cloud, and some of that cascades down into the Private Cloud environment. We have made a major release on the kind of UI and front end infrastructure that clients use to control Proximity and Exchange. So a lot of work done there to improve that end user experience. We've re-architected a lot of the platform, looking at new CPU architectures and getting more dense compute in the racks so that clients get more firepower for the money they spend. But another big area of investment over the last 12 months has been in security. I think anyone who's listened to us talk before, we're not in an overly price sensitive environment. Security and stability of the platform is paramount, and it's foremost in our minds and our customers' minds. We hired a new head of security just over a year ago, and he put forward a new enhanced security platform, which we've been implementing throughout the year, and we'll continue to do that next year. It's not an area that we will ever be conservative in budgets for, because a major security breach is the black swan event. So it's something that we are investing heavily in and hope to be best of breed in our sector for. I'll hand over to Fraser now just to talk through some of the numbers at a high level.
Thanks, Gordon. High level financials I'll cover, and obviously any more detail, then there's a Q&A session at the end that I'm happy to take any questions. So as Gordon says, another good year in terms of top line sales growth, where we hit 22% growth. So revenue 22.4 million from 18.3 in the previous year, and as Gordon says, driven really mainly by the kind of core Private Cloud offering, the underlying business. So another good year for sales growth. 91% of our sales were recurring in the year, right? So as Gordon says, we do have that visibility in terms of the current year. So the signings post year end and the GSE, the fact that was delivered in Q1. So we have about 90% visibility on the current year consensus forecast, which is 29.5 million. So in good situation there. And then in terms of how that sales growth is kind of translated into profit, so our EBITDA is up 33%, up to 8.4 million, and profit before tax also is up 13% from 2 million to just 2.3 million. We have had slight margin reduction on the year, so our profit margin for the year just gone through is down at 10%. Last year it was 11%, so not a huge amount of erosion there. However, Going back a couple of years ago, we were achieving profit before tax margins about 14-15%. So we fully expect that, you know, in terms of the current year, that we'll start to see some of that additional margin coming through. The kind of two key drivers for that: one is the exchange and the proximity cloud support is lower, and also we don't pay the OPEX costs in terms of power space connectivity within the data centers, because these appliances sit in customer data centers. So there's definitely scope for margin improvement there as that becomes a bigger portion of our revenue. And then the other kind of lever that we have this year is on staff, right? So staff traditionally has been about a third of our revenue. In terms of that headcount now, we've made that investment over the last couple of years. We've now built a team and, you know, just over 100 people that we really don't need to add an awful lot to. So, you know, over the next year or two, it'll be incremental headcount increase. Looking at the year ahead, we're looking at a staff cost of about 25% of revenue, and that's where we'll start to get operational leverage and start, you know, going back to profit margin that we had previously. So, you know, in good situation in that respect, we've really built the team, and, you know, the team we have now is capable of delivering a much higher revenue model than we currently are achieving. Not in the slides, but in terms of our balance sheet, again, we're in a good situation. We're in a net cash position. So net cash was 4.4 million at the year end. We've got relatively low levels of debt. So debt sits at 3.2, of which half of that is fixed. You know, so we're not, you know, we're still exposed to interest rate rises, but we're not massively exposed. And as I say, debt at sort of 0.4 times EBITDA, we're comfortable with. H2 was, as Gordon mentioned at the start, was cash flow positive, which was good. That's, you know, the first time since IPO where our operating cash is paid for our investment and our financing costs. There was some one-offs in the period, you know, so it's, you know, slightly higher than it could have been. However, we are, you know, on a monthly basis now, almost at the kind of break-even level from a cash point of view. And, you know, as we deliver those operational efficiencies this year, deliver the pipeline, we should start to see us generating cash. And that really is, you know, the focus of the business this year is to, you know, to increase those margins, start generating cash, given the last couple of years of investment. Okay, back over to you.
All right. So, you know, I'll kind of summarize and then we can go to Q&A. So I think key objectives for this year: convert the existing pipeline. You know, the pipeline at the moment is at record levels, some of which at the final stages, some of which still going through that painfully long financial services sales cycle that we, you know, have come to expect now. But, you know, if you look at it from end to end, it's much larger than it's ever been. And we've got a nice split between some very large deals, you know, kind of mid-size 1 to 3 million, and then the kind of smaller run rate stuff that we clear, you know, we tied up on a monthly basis. So there's a nice split in that pipeline, and you know, we you know, priorities to get that closed out. We'll continue to develop feature function throughout the year in terms of product innovation and product development. Already working with a number of exchanges, a number of clients on things that they want to see, whether that be as part of the first rollout or, you know, even with JSE, you know, we've got you know, enhanced feature functions that we can put into the product that future exchanges will benefit from. So that will continue. I think we're looking at leveraging the investments we've made in the business over the last few years. You know, as Fraser said, we're not looking at a huge increase in staff this year. This year is about continuing that top line revenue growth. And while I think overall maybe there's a bit of disappointment in the overall numbers for the year, I think we've kind of been consistently between 25 and 30% growth per annum since we started, since the business was formed, not just since IPO. So continue to look at the top line growth, but really we're looking now at the year of profit, the year of cash generation. I think we're now at a mature level when that's the focus. A lot of the heavy lifting to get us there has already been done, and it's now about execution and driving both top line and bottom line growth. So just to kind of summarise and look at an outlook on slide 11, we're in a good sector, right? Financial markets, despite some of the the economic problems at the moment, financial markets are actually it's a better sector than a lot to be in, and cloud computing within financial markets is still growing at a fairly decent rate, and it will not slow down. A lot of the larger enterprises are still very much at the start of cloud journeys, maybe some way through, but there's still an awful lot of infrastructure in-house that will move out up into the cloud. Pipeline is at record levels, as I said previously, and the focus for myself and the sales team is to get the transactions over the line and out there and build. Remember, we recognise revenue when the platform is being built and live. So, not just signing contracts, but getting the platform delivered. So I think we look into the year with confidence. We've got 90% coverage of the forecast already, kind of in the order books, and we've got some very large transactions and some medium-sized transactions that we need to go over the line. It would take something out of the ordinary, I think, for us not to get to the full year numbers. So we look at them with confidence. It helped with the GSE, revenue moving out of last year and into this year. It was timing rather than anything. So, yeah, we look ahead to the year ahead with confidence on the back of a good pipeline and 90% coverage of the numbers, and we continue to look at just execution. So that's all we wanted to cover.
Okay, I'll maybe pick up the first couple of questions. So the question is, please can you run through the unit economics of a typical client win, which includes CapEx, depreciation? In a nutshell, I see lots of growth, CapEx and depreciation, but I can't figure out if the business is profitable. Typically, slightly higher this year. We reckon it's about £10,000 worth of CapEx for £1,000 worth of recurring revenue, right? So if you break that down, our CapEx is it's a 5-year. We depreciate our assets, so you would be looking at about, over 5 years, you've got a sixth as your depreciation cost of your revenue. And actually, if you look at our depreciation through our P&L, that kind of rings true. It's about that in terms of that depreciation level. As I say, in terms of the profitability, would like to think we're at the lowest point here, right? So we're now starting to see leverage coming through. So in terms of our profit margins, as I said earlier on, there's definitely scope for improvement there, a gross margin because of the support and also from a staff point of view. I think next question is related. It says you're talking minimal headcount growth. And I think the question is that just to show leverage to investors, or is that right for the business? It's not driven by, investors and doing that. We do believe, we have the right team and the right size of team to deliver now. So, it's been a couple of years in getting that team, but, we're not doing it just to eke out more profit margins. We do believe that, we can support the business with this level of headcount.
Yeah.
I don't know if you want to
and and if that change, if the business grows, or when the business grows, and we think we're lacking resource or headcount, because the business survives in quality of service as well, stability, uptime, quality of service, then if we thought we'd service impacting issues for lack of staff, then we'd deal with that. I think, having spent most of the week with a long-term institutional holders, there's no desperation for us to, absolutely maximise at detriment to the business, the profit numbers. We're still very much a growth story, but growth has to now come with profit. So we'll manage that headcount as we go forward. What is the revenue potential of your installed racks at full capacity today? So that's from John. So the business has kind of changed a little bit. So that public cloud stroke some space for private cloud is really only part of the business. We used to be able to say, look, we've got £5 or £7 million worth of headroom in our existing data centers, but because proximity cloud and exchange cloud are not running in our data centers, it muddies it a little bit. I mean, it's more a case of what stock do we have. So we've got £2 million worth of stock in the stock room in the holds at Glasgow. That gives us, 6 or 7 million TCV of revenue opportunities. So that will get us to the full year number, the stock that we hold, right? Because that can be used for exchange, proximity, public or private. And then beyond that, we've got capacity. So it's more difficult for us to say now. I think you look at what is available revenue-wise for the stock, but on that, I think, supply chains have eased. We've only started holding stock over the last 2 years because of supply chain issues. Previously, we just bought to order, and we're slowly getting back to that. The supply chains have eased a lot, so we're going to run down that stock holding rather than having millions of pounds of sat in Glasgow waiting to go. So, and then we go back to buy to order. So it's been a bit of a drain on cash, and it sits there and it can sit there for a period. So that's not going to happen anymore. Once we drain that down, we might hold a little bit, but certainly not to the previous sizes. Sorry, I missed a question from John again. What does a big exchange cloud deal look like in size? Is it disappointing that it's such a small part of reported revenue for last year? Yeah, it's disappointing. I mean, I think we called out two big opportunities that we had line of sight on, and various things. Johannesburg was one of them. It's now come in, so that will be in next year's revenue, and then there's another much more material one. A big exchange cloud deal. So if you look at the top 5 exchanges in the world, they all have about 700 to 800 cabinets of customer equipment in their data centers. Now, Exchange Cloud is $1 million a cab for that first 4 or 5 year transaction. So a big, even the big exchanges have got 700 to 800. Not all of that would be available. We're not really in the HFT space. So, even if you say there's 250, 300 cabs of potential addressable market, if you get 20% of that, it's 50 million. So, that shows you the size of the opportunity, and that's per large exchange. When do you anticipate the Exchange Cloud from David cloud proposition to start making a net positive contribution to the bottom line? We'd hope this year. ICE, because of the ICE structure of the deal, it was never going to be like the follow-on Exchange Cloud opportunities. So JSE will make a material difference to this year, and we'll hope that the other ones that we have in play will be signed and deployed to a certain degree before the end of the financial year. So we would hope there's a material contribution this year.
I'll maybe pick up the next one from John. Is ACMRR still the key metric to assess the business, or is it changing due to proximity exchange cloud being more upfront? It's a good question. Yes, to answer. So, contracted recurring for us is still a key metric. The waters are slightly muddied by the upfront prox and exchange cloud, but we would expect to have both, right? We would always expect to have a healthy increase in the contractual revenue, and then layering on top the one-off deals was how we'd like to see it. I mean, you do get an element of the proxy exchange cloud as part of your ACMMR, so half is upfront and that remainder is smoothed over the annual recurring. So, but it's still a key metric for us.
And I think as we go on, when we update the market, it'll be broken down into ACMRR and then NRCs that we've already booked. So yeah, it's a good question. It's something we're conscious of. John, what revenue scale of business for BEEKS are you aiming for in the mid-term view, 3 to 5 years? I don't like questions like this, John, because we say something and then 3 years later, someone replays this and said that you were wrong. So being a fortune teller is hard, right? But I would like us to maintain that 25 to 30% growth rate at least over the coming few period, next few years. So that means the business will double again over that period. So other than that, it's very difficult to tell. But as I say previously, we've always been in that 25 to 30, smoothed over a number of years growth rate, and we hope to maintain that. Obviously, as we scale, that becomes more difficult, but bigger contracts, bigger customers, that also then helps. So difficult to say, but use that as a guide. Clients will always want new specific functionality. What's your approach to dealing with this demand? That's a good question, actually, because we do get this a lot where, a client will ask for a piece of functionality that we can never build in the product, and no one else will want that ever, right? It's just a specific piece of functionality. So we're not a software development house. We're not a bespoke software development house. So we really look at it as, is this enhancing the product for more than one client? And if the answer to that is yes, then we can take that forward, and goes through the all the other metrics that we use when we are picking out feature function. If the reality is it's for a particular exchange, the chances are if it's vital, we might charge them to do it, but we're not in the game of bespoke. We can scale this by keeping our platform mostly uniform. If you then start branching out and having very different deployments for every different exchange, it becomes a much more difficult business to support, and headcount's different. So good question, but yeah, that's a line in the sand. Is it going to be useful for more than one exchange or more than one client? You mentioned a very large potential addressable market opportunity. Are you exploring any additional ways of accelerating your market penetration? So I think yes. So ISVs have always been a big market for us, and we continue to, 3 out of our 5 biggest clients are actually ISVs. So there's a lot of companies in our space that sell applications, right? But they have to live on an infrastructure, related to infrastructure. So we continue to target more ISVs, because every time they sell their solution, we get an order on the back of it, right? And it's a really nice model, and that means we have by definition, they are out selling to their own customers that we would never see, and maybe use cases and workloads that's not really in our our normal line of business. So continue work through ISVs. The exchanges are the same as well. I mean, in Johannesburg when we were doing the kickoff, we picked up as much pipeline for outside of South Africa with banks and funds and whatever than we did for the actual GSE footprint, because they are getting to use our technology, see our technology, and then they look at applying it themselves, because they can buy it themselves in other locations. So the exchange, the big hope of the Exchange Cloud is, as the exchanges onboard clients, we get hundreds and hundreds of clients that use it through the exchange, but they will also have other environments. No one trades in just one place, right? People are trading around the world. So by using the Exchange Cloud and by using the ISVs, it means rather than having a sales force of 50 people that's very expensive, difficult to manage, we inherit their sales forces. But yeah, good question.
I don't mind taking this one. From Andrew, is there upside to FY24 revenues given the slippage of GSE into FY24 and the fact we've not increased our broker forecast? We hope so. Yeah, we believe so. We, going back last year, we had, a few upgrades to our forecasts. We will upgrade forecasts on the back of contract wins, but as we said earlier on, we have 90% visibility, which is not 100%, but it's a good bit of the way there. But yeah, we absolutely believe that there is upside potential there.
Last one from John. Do you see any good M&A opportunities? No. In a nutshell, we are absolutely not looking at M&A at the moment. Certainly inbound. We've had many informal approaches there for us going the other way, but we're nowhere near where we want to entertain the conversations. But there's too much organic growth opportunity for us to go and look at M&A, and we're still on the smaller side. So it would be reverse takeovers and huge fundraisers and risky. It's just not. I wouldn't. It's not in a wheelhouse. It wouldn't be something that you should be looking for or expecting us to do. Certainly in the short, medium term.
Perfect. Gordon, Fraser, thank you very much for that. I think you actually addressed all the questions from investors, and of course the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Gordon, could I just ask you for a few closing comments?
Yeah, sure, Alessandro. So yeah, I think the business grew last year. I think there is a level of disappointment internally about that level of growth, but it's putting us in a good position for the year ahead, and we'll be concentrating and getting these transactions over the line, and hopefully we get back to surprising on the upside of the forecasted numbers. So we're in a good position, and yeah, it's an exciting year ahead for us, I think.
Perfect. Gordon, Fraser, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of BEEKS Financial Cloud Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thanks,
Thank
folks.
you.
Thank you.